For over 100 years, a specific mathematical sequence has dictated every major financial collapse in the United States. It is not a coincidence. It is an architecture. In September 1929, a man named Roger Babson stood before a room of elite investors and uttered 9 words that would haunt Wall Street forever. Sooner or later, a crash is coming, and it may be terrific. The audience laughed. The mainstream newspapers mocked him as a prophet of gloom. Irving Fisher, the most celebrated economist of that era, publicly dismissed Babson, declaring that stock prices had reached a permanently high plateau. 47 days later, that plateau disintegrated. The Great Depression began. Fisher died in absolute poverty, while Babson, who understood the pattern, made a fortune. Today, in 2025, we are witnessing the exact same arrogance. The same deceptive phrases, a soft landing and resilient economy, are being recycled by the Federal Reserve and corporate media. But the math does not care about optimism. We are not merely looking at a market correction. We are approaching a systemic reset that occurs once every 80 to 100 years. This is the hidden warning of 1929 reappearing for 2026. Most Americans will lose their 401ks, their home equity, and their financial sovereignty because they trust the experts over the historical patterns. But the patterns never lie. Today, I'm going to peel back the curtain on the 5-stage sequence that precedes every total collapse. I will show you exactly where we are in that cycle right now and why 2026 is the calculated target for the largest wealth transfer in human history. This is not a prediction. This is an autopsy of a system designed to fail. Economics is often presented as a complex social science, but that is a deception. At its core, the global financial system is a machine, and like any machine, it has a breaking point. Wall Street elites do not trade based on hope. They trade based on a 5-stage sequence that has remained unchanged since the Dutch tulip mania. The first stage is displacement. This is when a new technology or a shift in Federal Reserve policy creates cheap money. In the 1920s, it was the radio and the automobile. Today, it is artificial intelligence and the massive liquidity injections following the pandemic. Money floods the system, looking for a home. The second stage is the boom. This is the period of euphoria where your neighbor, your barber, and your social media influencers all become financial geniuses. The S&P 500 climbs higher every week, and the fear of missing out overrides the fear of losing everything. The third stage is euphoria and overtrading. This is the most dangerous phase where leverage becomes the primary engine. In 1929, people bought stocks on a 10% margin. Today, through complex derivatives and the yen carry trade, the level of hidden debt in the American financial system is 10 times higher than the official figures. The fourth stage is distress. The smart money, the insiders, quietly begins to exit. They need your buy-the-dip mentality to provide them with the liquidity to sell their massive positions. This is where we are right now in 2025. The insiders are selling while the retail investor is being told that the Goldilocks economy will last forever. The final stage is revulsion and panic. The exit door is too small for everyone to leave at once. The math simply stops working. When the leverage uncoils, it does not descend in a straight line. It collapses like a house of cards in a hurricane. Wall Street stays silent because they need you to stay in the burning building until they have safely escaped. This sequence is not a flaw of capitalism. It is the heartbeat of a system designed to concentrate wealth at the very top. To understand 2026, we must look at the data the mainstream financial media chooses to ignore. If you dig into the archives of 1929, you will find a chilling mirror of our current reality. The official narrative back then was that the United States had entered a new era of permanent prosperity. Sound familiar? Today, they call it the digital revolution or the artificial intelligence boom. The math buried in the archives tells a different story. In the 3 years leading up to the Great Depression, margin debt, money borrowed to buy stocks, tripled. Today, the total amount of leverage in the global financial system, including shadow banking and derivatives, is estimated at over $2 quadrillion. That is $2,000 trillion. It is a number so large it loses meaning, yet it is the foundation of every 401k in America. In 1929, the top 1% of Americans owned nearly 40% of the nation's wealth. Today, that concentration is even more extreme. The archives show that in early 1929, the smart money, the Rockefeller and Morgan interests, began moving their capital into gold and short-term liquid assets. While they were exiting, the newspapers were encouraging the middle class to use their savings to buy blue-chip stocks at record-high valuations. The most suppressed truth is that the Federal Reserve, created only 16 years prior in 1913, deliberately tightened credit in 1929 after years of fueling the fire with cheap money. They pulled the plug on the bathtub while the public was still jumping in. We see the exact same architecture today, a decade of 0% interest rates followed by the most aggressive rate hikes in 40 years. The trap is set. The elite archives prove that these collapses are not accidents of nature. They are the harvesting seasons of the financial empire. They allow the debt to grow until the fruit is ripe. Then they crash the system to buy back the world for pennies on the dollar. In the lexicon of financial deception, few phrases are as dangerous as the soft landing. It is a masterpiece of economic propaganda designed to do one thing: keep the public invested while the exits are being quietly utilized by the elite. The mainstream media in 2025 is obsessed with the idea that the Federal Reserve can miraculously raise interest rates, crush inflation, and avoid a recession all at the same time. History, however, is a brutal teacher. Since the inception of the Federal Reserve in 1913, there have been several attempts to engineer a soft landing after a period of massive credit expansion. Out of those attempts, only one was even arguably successful, and even then it was followed by a massive surge in debt. The reality is that once the debt-to-GDP ratio crosses the 100% mark, as it has in the United States, the mathematical probability of a soft landing drops to zero. In 1929, the narrative was exactly the same. The headlines in the spring of that year assured Americans that the fundamental business of the country is on a sound and prosperous basis. They argued that the new tools of the central bank would prevent any significant downturn. They used optimism as a weapon to ensure that the retail investor would continue to provide liquidity for the smart money to exit at the peak. What the experts won't tell you in 2025 is the lag effect. Monetary policy takes 18 to 24 months to fully impact the economy. The aggressive rate hikes we have seen are a delayed action fuse. By the time the public realizes the landing isn't soft, the ground will already be rushing up to meet them. In 2026, the illusion will vanish, revealing that you cannot fix a decade of artificial prosperity with a few minor adjustments. You cannot land a plane that has no wings and is running on empty. To the average investor, a financial collapse feels like a chaotic act of God. But to the architects of the global financial system, it is a scheduled harvest. You must understand one fundamental truth. The elite do not fear crashes, they design them. Think back to 1929. While the middle class was jumping out of windows because their life savings had vanished, the House of Morgan and the Rockefeller interests were sitting on massive piles of cash. They did not just survive the Great Depression, they used it to consolidate entire industries. They bought railroads, steel mills, and banks for 5 cents on the dollar. This is the architect's playbook. It is a 3-step cycle of wealth extraction that has been refined over centuries. Step 1 is artificial expansion. The central banks flood the economy with cheap credit, encouraging everyone from homeowners to corporations to over-leverage. Step 2 is the controlled demolition. Interest rates are hiked under the guise of fighting inflation, causing the debt bubble to burst and liquidity to dry up. Step 3 is the great consolidation. As the public panics and sells their assets at fire sale prices, the elite use their pre-positioned liquidity to buy the world. In 2025, the playbook is being executed with clinical precision. We see massive insider selling by the world's most powerful CEOs. We see institutional giants like BlackRock moving toward distressed asset funds. They are preparing for the 2026 purge. They want you to stay diversified in a falling market so you can provide the exit liquidity they need. While you are taught to hold for the long term, they are preparing to own the long term. If you want to survive the coming sequence, you must stop thinking like a victim and start recognizing the movements of the architects. They are not hiding their moves. They are simply waiting for the fruit to ripen before they pull the plug. Most people look at the $34 trillion national debt and think it is the primary problem. It is not. That number is merely the tip of a much larger, darker iceberg. The real math of no return lies in 2 hidden monsters: the derivatives market and the yen carry trade. The global derivatives market is currently estimated to be over $2 quadrillion. To put that in perspective, that is $2,000 trillion. This is a mountain of bets on top of bets, held together by the illusion of constant liquidity. It is a house of cards built on a foundation of gasoline. When the underlying assets begin to wobble in 2025, the leverage does not just shrink, it explodes. Then there is the yen carry trade, the secret engine of the American stock market for decades. For years, big institutions borrowed money in Japan at nearly 0% interest to buy high-yielding American assets. It was free money. But now the Bank of Japan is finally raising rates and the yen is strengthening. The cheap money is disappearing. This is causing a massive unwinding where trillions of dollars must be liquidated almost instantly to cover margin calls. This is why the math does not work. You cannot fix a $2 quadrillion problem with a few $1 billion in bailouts. We have reached the point where the interest on the debt is growing faster than the entire economy. In 2026, the system reaches its mathematical limit. The elite know this. They are not trying to save the system. They are preparing to liquidate it. For the average investor holding a traditional portfolio, you are not participating in a market. You are trapped in a liquidation event. The math is cold, it is final, and it is telling us that the time for hope is over. In the final months before a collapse, people become obsessed with the trigger. They want to know the exact date and the exact event that will start the slide. But here is the paradox that most investors miss. The trigger itself is often irrelevant. A forest that has been dried by a decade of drought can be set ablaze by a single discarded match or a random bolt of lightning. The disaster is not the match. The disaster is the state of the forest. In 1929, the trigger was a relatively minor financial scandal in London involving the Hatry Group, which shaken investor confidence just enough to reveal the massive cracks in Wall Street's margin debt. In 2008, it was the bankruptcy of Lehman Brothers, a single institution that triggered a global cardiac arrest. For 2026, the trigger is already being built into the system, the sovereign debt cliff. The Federal Reserve has backed itself into a mathematical corner. If they lower interest rates to save the banks, inflation returns with a vengeance, destroying the purchasing power of the middle class. If they keep rates high, the entire commercial real estate market and the banking system disintegrate under the weight of trillions of dollars in underwater bonds. The black swan of 2026 will likely be a liquidity crisis where the U.S. Treasury finds it can no longer attract enough buyers for its debt without the Fed printing trillions of new dollars. When the world realizes that the risk-free asset, the U.S. Treasury bond, is actually the epicenter of the risk, the plug will be pulled. It won't be a slow decline. It will be a sudden, violent disappearance of liquidity. One day the ATM works. The next day, the system is under maintenance indefinitely. One of the greatest lies in finance is the idea that wealth is destroyed during a market crash. Wealth is never destroyed. It is simply transferred. When the dust settles in 2026, the physical assets, the real estate, the corporations, the farmland, and the infrastructure will still exist. The only question is, whose name will be on the title? While the average American watches their 401k evaporate and their home equity vanish, a very specific group of players is waiting in the shadows with trillions of dollars in dry powder. These are the institutional giants like BlackRock, Vanguard, and the massive private equity firms that operate as the enforcement arm of the banking elite. They do not invest like you. They do not buy and hold and hope for the best. They wait for the revulsion phase, the moment when you are so terrified that you sell your assets for 20 cents on the dollar just to make the pain stop. In 1929, the Rockefeller and Morgan families used the collapse to consolidate the American banking system, moving from thousands of small, independent banks to a handful of massive institutions that they controlled. In 2008, we saw the birth of the institutional landlord era, where firms like Blackstone bought up tens of thousands of foreclosed family homes. In 2026, the target is even larger. They are positioned to inherit the rubble of the commercial real estate market and the distressed tech sector. They are not trying to save the economy. They are waiting for the liquidation event so they can buy the American dream at a discount that only occurs once a century. This is why the system is allowed to fail. A functioning system provides stability for the many, but a collapsing system provides total ownership for the few. The most profound realization you can have is this. The United States dollar is not backed by gold, oil, or even the strength of the American military. It is backed by debt. In our current monetary architecture, money and debt are the same thing. For a new dollar to be created, someone, somewhere, must take out a loan. This creates a mathematical trap from which there is no escape. If the United States were to actually pay off its national debt, the global money supply would effectively vanish. The system would stop breathing. This is the exorbitant privilege turned into an exorbitant burden. Because the dollar is the world's reserve currency, we are forced to export debt to the rest of the planet to keep global trade moving. But we have reached the end of the line. History shows that reserve currencies have a natural lifespan of roughly 80 to 100 years. The British pound, the Dutch guilder, the Spanish real, they all followed the same trajectory of expansion, over-leverage, and eventual collapse. The Bretton Woods system began in 1944. We are now 81 years into this cycle. The pressure is mounting. The rise of alternative payment systems and the weaponization of the dollar have accelerated the de-dollarization process. By 2026, the weight of interest payments on the $34 trillion debt will consume nearly every tax dollar collected. The system cannot be fixed because the debt is the system. You cannot fix a cancer that has become the vital organ. The only way out for the elite is a total systemic reset, a controlled demolition of the old dollar to make way for a digital, centralized alternative. They are not trying to save your purchasing power. They are preparing to replace the burning house with a digital cage. The historical pattern of 2026 is not a death sentence. It is a call to action. While the elite prepare for their harvest, you must prepare your fortress. Survival in a systemic reset comes down to three pillars: liquidity, protection, and exposure management. First, prioritize cash reserves. In a liquidation event, cash is king because it allows you to survive without being forced to sell your long-term assets at the bottom. Second, reassess your 401k. If your entire retirement depends on 5 mega-cap tech stocks staying at record highs, you're not diversified. You are overexposed. In a crash, correlations go to 1, meaning everything falls together. Third, move toward physical gold and silver. For 5,000 years, gold has been the only financial asset that is not someone else's liability. It is your insurance policy against a failing currency. Stop listening to the experts who are paid to keep you in the market. Look at the data. Look at the patterns. The people who were destroyed in 1929 and 2008 were not stupid. They were simply trusting. Do not trade your future for their false sense of security. The warning has been given. The sequence is clear. Your financial sovereignty is now in your hands. Subscribe and turn on notifications to stay ahead of the next stage in this pattern.